Today, we are talking about the 1031 Tax Deferred Exchange. I'm hanging out with Michael Fleenor of Robinson Grant, one of the top CPA firms here in the Low Country, my personal and professional CPA firm. So if you guys are looking for someone to be in touch with here locally, even if you're out of state and you need a South Carolina expert, just know that Michael and his crew are here. And so it's great being with you today. Appreciate the opportunity to talk about your market or your knowledge base on the 1031 Tax Deferred Exchange. So appreciate your being here.
Thank you, Chip. I appreciate the opportunity to be here with you.
Yeah, absolutely. So here's the thing, guys, is that we know that if you don't know about a 1031 Tax Deferred Exchange, which I think is an AKA Starker Exchange, is that right?
It is.
Is that known as, is there any other name that people might have heard about it, like a swap or any other term?
So most often you might hear it as a like-kind exchange.
Yeah. Okay. So let's go right at that then. Okay. So like kind, I think that is one of the more interesting things about that. And so just to back up a little bit, we're talking about primarily investment properties. So if we're thinking primary residences, people get confused about that. Not talking about primary residences. We're talking about investment properties. And let's go into what like kind looks like. Because we hear people say, well, I want to sell, I've made some money on a property and I want to sell it and buy something maybe bigger or different, reallocate those funds. A lot of people get in that channel like, oh, I guess because I have a short-term rental house, I got to go to another short-term rental house. That's not the case, right?
That's not the case. So the like-kind exchange, or the 1031, which is named after the IRS code, is really intended for investors who have real estate that they hold as an investment or they use it in a trade or business.
Yep, sure.
So it's not intended for primary residences. Right. Could it be used for a vacation rental home?
Yep.
Yes, absolutely. But there are limits to that, including whether or not an owner of that property uses it for their personal use throughout the year.
So what's the actual, in order to what's the limiter on that? Like, is there an absolute number of days that the owner can't exceed for personal use?
Yeah, so there's kind of a formula that you have to look at in determining whether or not that type of property would qualify for a 1031 exchange.
Okay.
Generally speaking, an owner couldn't use that property more than 14 days during the year, or a percentage of the total number of days that it's rented to a third party.
Oh,
it's fair market value.
Got it. So if it doesn't rent a ton and it might sit empty for a period of time, that could, on the percentage basis, that could actually reduce that 14 days down to fewer.
It could.
Okay.
It could.
Interesting. So let's go back to that like kind. So you might have someone who comes out of, because that's a really, like with our audience, that's a really common scenario. One of the reasons that people love buying real estate in the Low Country is the ability to rent it while they're not here. And we find a lot of people like, I'm going to start with a villa, and then we might go into a home, and then they might ultimately end up moving here, right? Mm-hmm. So the like kind thing is interesting because we've seen people that have sold maybe a long-term rental property someplace else. So they've got an annual tenant, and then they want to roll that into a vacation property here that they're also going to rent. Is that like kind?
Yes, it is. And in fact, like kind even extends beyond that in the sense that, by nature, real estate may be like kind, but it may not be the exact type of real estate.
Sure.
For example, someone could exchange a condominium for vacant land.
Right.
And that's still considered the same nature as a piece of real estate.
Vacant land being something that they just hold but maybe don't improve.
Maybe they have intentions to improve it, but it's currently an unimproved piece of property.
So, and there are other examples. Like I've looked at, and I know we can provide this list to folks, but there's kind of a long laundry list of property types or kinds that are like the others that fall into this 1031 exchange.
That's right.
So I think people need to understand that there's a wide variety of ways to apply that could be eye-opening, like I said, because we find a lot of people basically say, well, I guess I've got to go from a short-term rental to a short-term rental. That's not exactly it. So let's go into some of the guidelines, and we see this about that there are timelines associated with this. My understanding is, and you kind of help fill this in, is that once you've closed on what do they call it? Relinquished property.
Correct.
Right? The
The property that you give up.
that you're selling, you've got how many days before you need to identify the replacement property?
You have 45 days from the date that that deed is recorded that you've sold the property that you own that's appreciated in value.
Sure.
So you're wanting to, the whole purpose of the 1031 is you're wanting to defer the capital gain taxes that you're going to pay. So that starts the day that you sell that property. 45 days after that, you have to identify at least one property that you're going to replace it with.
Okay. And so that stopwatch starts, and I appreciate the clarification because it's not necessarily on the closing date, although that's where the money flows, but it's the recording of the deed. So the stopwatch starts, 45 days runs on that, but there's another time period that's also running contiguous with that to when they've got to close on that replacement property. How many days is that?
That's right. You have 180 days to actually receive that replacement property that you are exchanging your previous property.
Okay, so you got half a year,
Right.
which most people don't take that much time to do it. I mean, I find that people sort of have figured this out. They've got a pretty good idea. They've kind of put the chess pieces on the board, and they already know, like, if I can sell this, I want to jump into that. As opposed to, if I sell this, I'll do it, and then I'll start shopping. A lot of people sort of have an idea what they want to do.
Right. And, there could be situations where that matches up perfectly and you've already got someone that has a property that you want to replace, and
Sure.
it could be a pretty quick sell. But I would also add that this is kind of an appealing thing to a seller because it's almost like a cash sale. So it can happen a lot quicker because there's that clock that starts running for the person that's wanting to take advantage of the 1031 exchange.
That's right. We see that. You sort of have for lack of a better terms, maybe a captive buyer. Like, the money is there. This is not someone who's monkeying around or just trying to say, well, I'll make a bid. It's like they're trying to buy a property and they're under the gun or the clock a little bit.
Right.
So let's talk about that. You're deferring taxation. Super important. You are not getting away with taxation. You're not having that doesn't go away. You're just deferring that for some future event that we could talk about. Is probably maybe the sale of the replacement property, or maybe you do it again, etc. But there's a counting of that through time, right?
There is. And so that's the beauty of the 1031 exchange is you have this appreciated property that you're going to have some capital gains at some point, and you're going to have to pay capital gains tax on. But the 1031 exchange gives you the opportunity to move that forward into the future without having to pay capital gains tax currently. And in fact, you could continue to do this for a number of years if you wanted to, and even to the point where eventually that property is passed to your heirs and you've essentially never paid the capital gains tax on that property.
That's pretty cool. And that's a future conversation with someone one-on-one with someone like yourself to kind of talk about that strategy. But I've always wondered about, like, do you ever get to a point where you sort of come to the end of the road and you don't have to deal with it? That might be what that looks like. So I appreciate that. And then the thing is, when you don't, if you're deferring taxation, again, you're not eluding it, but you're deferring it, the money sits someplace interesting. So you sell the relinquished property. As a seller, typically you sell a piece of real estate, you get your money. Not in this case, right?
Right. And you have to be very careful about that. Again, this is tax deferred, not tax free.
Right.
And so as a seller who's wanting to take advantage of this 1031 exchange benefit, it's important that you as the seller never have access to the cash that's received from the sale of your property. Because if you get access to that cash or you get it in hand at some point, then you've essentially potentially given up your opportunity to take advantage of the 1031 exchange. And so to mitigate that, you have what's called a qualified intermediary, who is an entity that is going to be the person that's holding the proceeds from the sale of your property and then basically purchasing the replacement property on your behalf and exchanging the money for the replacement property and then turning it over to you to make sure that you never have access to the funds that you received from the sale of the original.
Yeah, I was thinking of like the MC Hammer thing, like can't touch this stuff. Once you touch the money, you're going to get taxed on it, basically. So you got to have somebody else that can have the money.
Correct.
And so this QI, Qualified Intermediary, does that. And they work with you as the CPA. They work with the closing attorneys. They work with the buyer, the seller, et cetera. And all that's good. And the money just sits there while that stopwatch is running until they get to the replacement property. I suppose if someone aimed to do that and then change their mind, and they could just call the QI and say, submit my money because I'm not going to do the 1031. Like it's failed.
They could, or it could be that they simply don't find a replacement property within the time parameters and it falls through.
It falls through that way. Is there ever are you aware, is there a chance to do an extension on the 145 days and 180 days?
It's very rare, if ever, that there's any extension on those 45 and 180-day periods. And they do have to be very carefully documented in the tax form that is required to be filed in the year of this exchange. You have to include all of those dates to inform the IRS, hey, I'm doing this in proper order.
Sure. So let's talk about proper order really quickly. There's something called a reverse 1031 exchange, where you actually, instead of selling the relinquished property first, is this right? You buy the replacement property first. Have you done those? What does that look like? And that's more complicated.
Yeah.
And, that takes more work. There's more paperwork. It's more expensive to conduct that transaction, but it's possible, isn't it?
It is. That's an interesting scenario when you do buy the replacement property before you found a buyer, essentially, for the property that you're wanting to give up. Mm-hmm. And as you mentioned, it is more costly. And the main reason for that is because there's another intermediary that has to get involved, which is typically set up as a single member LLC. And that LLC is the one that actually purchases that replacement property, temporarily owns that property, and then you, as the buyer, buy that property from the LLC. And again, that's to make sure that those time parameters are met and that you're never owning both properties at the same time.
Yeah. How cool is that, though, right? I mean,
absolutely.
So a lot of times people don't think there's a lot of flexibility in tax law and processes, but that's one that we've seen folks do because life gets in the way. Sometimes you find that perfect property, you don't want it to get away, and you're super excited and you feel like you can go ahead and sell your relinquished property in a timely fashion, but the two are not going to necessarily line up. For the IRS, that's a way to make that happen.
Right. And that's really important in a competitive market, such as the Low Country.
Yeah.
Things move fast. Yep. And it may be important to strike the replacement property and then find a buyer. And in this market, it may not take long to do that.
Well, so we've seen a lot of property appreciation throughout the country, certainly in the Low Country, from the COVID market moving forward. And I think a lot of people are we're starting to see more and more 1031 discussions, which is why we want to talk about it. In the time, 09 to 19, the market was pretty flat. Values dropped down. It's like it was a ghost town on 1031 tax deferred exchanges just because it didn't happen. The equity really wasn't there.
Right.
Now the equity's there. Mm-hmm. So we're challenging people to think about what else could you do if you wanted to maximize that equity, not have taxation on it. What could you end up doing? And it opens up a world of possibilities. You might sell a property that's appreciated well in the Low Country and turn that into a long-term rental that's closer to home. Maybe you have a friend or a family member that rents it. Like there's ways to start thinking about moving those funds and the leverage of that, because that's the beauty of it too. What we talk about is you defer the taxation, which can be pretty hefty, and you keep the leverage of that money in your purchasing power.
It's an incredible opportunity because you're holding on to those funds that otherwise would go to pay taxes. And you're able to reinvest those. And that's why 1031 exchanges are a beautiful thing for landlords, investors, and business owners as well when thinking about their commercial property. The other thing that I would add to that would be the importance of remembering that to get the true benefit of a 1031 exchange, your idea is to buy up. In other words, you've got an appreciated piece of property that you're going to have a capital gains tax on. but you're wanting to look for a property that's really worth more than what you're giving up so that you don't end up having to pay some form of capital gains tax on what's called boot that you might receive, which is cash or non-like-kind property that someone might have to give you to kind of make up for that fair market value.
But that's a great point, is that somebody might not want to spend all of that. They've made a fair amount of money on this property. They don't want to buy at that same level.
Right.
Let's say they want to cash out some portion of it.
Mm-hmm.
That's called boot. The MC Hammer thing, if you touch it, you're going to get taxed on that. But you can take the rest of it and put it into 1031. Is that right?
That's right.
Yeah. And you could buy multiple properties too.
You could.
By the way, right? So you might break that apart. You could buy a rental house and a piece of land, and go down that laundry list that will provide to people of things that qualify.
And again, keep in mind that by definition, like kind is a permanent structure that's affixed to a property. So you're thinking houses, buildings. It's not something that can be moved off the property. And that's important to understand as well.
Got it. So does that mean like a trailer or RV or something else that might be able to generate rental income, but that doesn't necessarily apply?
Right, because that would fall more under a personal property category.
Okay, so if anybody wants to get involved in this, they can certainly ask questions of us, but also ask questions of you, because we always listen. This is one of those examples where if you think about a swimming pool, like I don't swim in your lane, but I kind of know what it looks like. So I could kind of go down there and talk and speak intelligently about it, but we always suggest people talk to the experts, to the source of information. And so we encourage folks to reach out to Rob and Screen. Ask for Michael Fleenor, because he's a rock star, as you guys can see. And we certainly thank you for your time. Hope this was informative for you guys, and we'll talk to you soon.